Hello, this is Mike Swanson. I run the website WallStreetWindow.com, and the odds are that you're watching this video because you got an email from me telling you that it's up for you to see. Now, if you're not on my email list, click the link you see with this video to get on it. Then you'll get all of my future updates. Typically, I send out an email every single morning, trading day, in which I show the top headlines of the day that I'm following that I think are important for you to know about, and also my market commentary. Now, I'm doing this video on January the 2nd, 2022. Tomorrow is going to be Monday. It's going to be the first trading day in the United States. There's some markets outside the United States which are going to be closed, but this is going to be the first trading day here. And there's this is the time in which everyone in the financial media and people that like to talk about the markets make predictions on what is going to happen in the next year. And people like to hear predictions, especially if the prediction is that what they own now is going to go to the moon. So over this weekend, you probably saw dozens, well, if you're watching them, of videos on YouTube from crypto people predicting Bitcoin to go up. It wasn't just a year ago that a lot of these people were saying Bitcoin would go to 100,000. Then obviously that didn't happen, and Bitcoin fell below 50,000. And I want to suggest to you that the best way to think about the markets isn't to make a prediction about what they might do or listen to someone else make a prediction, because nobody can really predict the future. And when people make videos on YouTube, the way the algorithm works, it rewards people who say what other people want to hear. So, for example, if I was trying to do videos about crypto, the best thing I could do is keep making predictions that it's going to go up, it's going to go up, it's going to go up. And what will happen is people will watch it, they'll like it, they'll want to hear it again. And YouTube algorithms will recognize that and keep showing them my video. But if I was to say, hey, crypto people, crypto is going to crash, you don't want to be in it, then the algorithm, those people would get mad, or they'd cut off the video to find something they like. YouTube would see that, then YouTube would show less of my videos. As a result, I don't do videos about crypto at all, because I think, I don't own crypto. I don't trade crypto. I like to buy stocks that represent ownership in companies that exist in the real world and can pay a dividend, have earnings, and so forth, versus some virtual currency. The virtual currencies are good for speculation because they can move up and down very quickly. And if you can get on that and win, that's good. But I don't really view them as long-term investments. And I got a time frame where I like to hold stuff for several months and hopefully for years. And instead of thinking in terms of predictions, the most useful thing to do is to think, when it comes to trading markets, including crypto, no matter what it is, gold, crypto, bonds, stocks, the best thing to do is not think in terms of predictions, but in trends. Identify what the current trend is and look for changes in that trend so that you may adapt when that happens. And let me, in this video, quickly show you some of the key charts and trends I'm watching for now. At the start of this year, I got to share my screen. And the first thing is that the basis of my trend analysis is always to look at what the big picture is. When you load up a Robinhood app, all you see is the daily price gyration. It's usually meaningless. The best way to figure out, or the important stuff, is the big long-term trend. And where that's at and then where the shorter term trends are in regards to that. So the long-term trend is what you see on a chart going back at least 12 months. The shorter term trend for me is what's going on in a week. Then you got a day, then you got an hour, and so forth. But just seeing, what something happens to in a daily basis in itself isn't very meaningful. So the big trend identified through stage analysis. Basically, there's 4 stages to a market cycle: a basing phase, stage 2 bull market, stage 3 bear market, stage 3 topping market, then a stage 4 bear market. Where you are in regards to the market is determined by, but an easy way to figure it out is how is the 150-day and 200-day moving average acting relative to the price. Those moving averages tend to act as support in bull markets, resistance in bear markets, and when you're in a topping phase, the averages tend to flatten out a bit. And the market itself tends to, the momentum fades, things get more volatile. And also when it comes to a stock market, typically you'll find in the stage 3, few stocks are going up and most stocks are trading below the 200-day moving average, which that is something that began to happen this fall, a huge warning sign in the trend that suggests that we could be heading into a bear market at some point this year. Probably not immediately, most likely not immediately, because just the end of the year, the S&P 500 did make a new high. We have earnings reports that are going to come out before the end of January, and the market tends to rally into earnings, then take some profits as they come out. And seasonally, the market tends to do good in January. December, January tend to be the most bullish months. December this past year was not, which is also a sign that, look, we're not in really probably the stage 2, because, almost always the market goes up in Thanksgiving week, and in December, in Thanksgiving week, it fell. December, that S&P did dip in the first half, come back up, but a lot of stocks did not. And so what I want to look at right now is what are the big trends in several key markets. And even if there was a bear market in the US stock market, some sectors will do well. And there are sectors that I think, I'll just go through a couple of charts. I'll point out some interesting stuff. Here's the S&P 500. It did pop up to a new high at the end of the year. I could easily see it, it just made a new high. It came briefly below the 50-day moving average and popped back up. However, this is the warning sign. This is the percentage of stocks above the 200-day moving average in the entire stock market. That indicator peaked at the beginning of last year. To me, it was apparent by July that this was turning down, and the indicator plunged in November, which is a huge warning sign that we're in a stage 3 top, even though the S&P did make a new high last week. Personally, what I did, everyone's got different risk tolerance in ways they allocate their money as an investor. And if you go to, say, where I live, to an Edwards and Jones broker, they'll typically tell you put half your money in the stock market, half your money in bonds, and every year rebalance. So if your stocks allocation, stocks go up so much that you're no longer 50% invested, but 55, sell some and put the money in bonds to balance out your portfolio. Now, what I did, I came into 2021 roughly 70% invested, with a 30% position in CDs. But by July, I saw that the internals of the market were starting to weaken, and I don't like that. that's a risk factor. So I moved back my 70% allocation down to 50%. That's where I'm at now. And if, I may actually hedge. There have been times where I'll put on hedges and take them off. I've done that, that's a more tricky trading thing for people to do, but I may do that again sometime. Anyway, that's a whole other topic. But this is, to me, one of the most important things that developed last year is this indicator going down. And there's another indicator that's interesting that shows you the internals of the market with buying and selling volume. And it peaked for the S&P 500 in November. So this indicator is not confirming the recent high. If this indicator goes below, below the low of December, that would be a sign that selling is intensifying the S&P 500. I don't expect that to happen, this week or next week, but it's something to look for as this new year goes on. Now, to show you how an example of these negative divergence in the market, here's the Russell 2000. It peaked in November and is not trading as well as the S&P 500, obviously, and it's right on the 200-day moving average. So this is a big negative divergence. And this is a trend that's likely to continue in the markets, in which the S&P outperforms the Russell 2000 because you can get a few concentrated stocks, and that'll be something to talk about in another video, that help the S&P 500 go up, while most stocks are not. 2,000 stocks in here not doing as well as the average S&P of 500 stocks. And this is also showing up in so many of the popular fad stocks that people came into the year with that are owned by things such as the ARK ETF. The ARK ETF is in a bear market. This is trading below the 150 and 200-day moving average. When something is trading this much weaker than the stock market, what it means is if there is at some point a pullback in the S&P 500 of just 10%, this thing will go down quicker and faster. And you see how it did that in November as example. The S&P didn't even pull back 5%, but this thing took an over 10% hit. Very nasty. The stocks in it are many of the popular stocks on Robinhood. To point out one, Zoom. Zoom is in a bear market, way below the moving averages. And there's many stocks like this now in the US stock market. If you have a Robinhood account, write down all of the top 100 Robinhood stocks that most people own and look at them and chart them out like this, and you'll see the majority of them are in bear markets. Herd investing is something that was talked about at the start of 2021 as a great thing. You could just get on a message board, buy AMC, buy crypto, and make a killing with the herd. The year ended showing and demonstrating, as this stock does, because this is one of the herd stocks, once again, that herd investing in the long run leads to losses. You don't want to be a herd trader. Now, here's something that I own. I'm invested in this sector, and it just made a new high Friday. It's RWR. I own this ETF actually in my retirement account. It tracks real estate investment trusts, which tend to pay nice dividends. They're companies that own real estate, and they make income from renting out the real estate and paying shareholders a nice portion of that revenue. I believe that real estate is going to continue to go up in the years to come, because real estate goes up when you have inflation. And the inflationary trend, which became evident to everyone in the second half of last year, is something that is likely to continue. Think of trends like this. Identify the trend in place. Assume it's going to change until you see evidence that it does not. The trend for things such as the ARK ETF, they're already in bear markets. The trend for real estate is in a bull market, and so is this ETF, and so are the stocks in it. So if you want to invest in sectors in bull markets, avoid things such as Zoom, Penn. I can make that's a whole other topic. So this is the stock market. Some sectors I think are good, a lot of stocks bad. And that's more pronounced now than the years in the past because of the plunge in the percentage of stocks above the 200-day moving average. Now, other markets that are critical are the bond market is one. And, it looks like we're heading for higher interest rates this year because inflation is going to force the Fed to raise rates. The Fed fund futures are projecting at least 2 rate hikes this year, likely 3. And when interest rates go up, the value of bonds go down. And LQD is a corporate bond ETF. Now, I actually have puts on this ETF as a hedge. And I think eventually this year that this will go down in value as interest rates go up. And if stocks go down, this tends to go down too. So I actually have this as a hedge in my account right now with a little bit of position on that. But this is one of the challenges that all investors now deal with. Typically, historically, when the stock market would go down or there was a recession, bonds would go up in price, thereby making the typical 50-50 stock portion allocation, bond portion allocation, a great diversification investment strategy because if stocks went down, bonds went up. Great. However, I think we're entering a new era in which bonds are not going to act like that. I think this is going to be more like the 1970s, where inflation really can hurt the bond market. And at times, if the stock market goes down, bonds may go down too, or at least not go up. And the problem is we got 0 rates after the market dumped in 2020. So there's no room for the Fed to lower rates. There's such little upside in bonds and in the long run. So that's another reason I think the bond market is not really a great investment, except when you have nowhere else to put your money. It's the only real reason to buy them at this point. There's just no great upside. So that brings us to the question, where else can you put your money? And the answer to that is commodities and gold. And I think gold at some point is going to turn up to the upside. Now, gold has spent the entire year, even longer, going sideways in a long, drawn-out consolidation phase. It's starting to finally tick up now. It's likely to test resistance at the top of that range, which is essentially 1890. But it needs to break through that to go through a bull run of its own. So that's something we got to look forward to, wait on. I can't predict the moment it will happen, but the bullish factor for gold is the problem with the bond market having such limited upside and the potential to eventually go lower as rates go up and inflation goes up. So that's one reason I got a portion of my money invested in metals ETFs and mining stocks. And I think they're in a good position to start to rally here with what's happened over the past week, where, gold is it hung around 1800, then popped up a little bit. Looks like it's going to challenge resistance at 1890. And a break through that is what is needed to start a big bull leg up. So we got the chance of that happening, but a nice rally likely to happen. And small cap mining stocks tend to seasonally trade weak in the fourth quarter, then do well in the first half of the year. So That's something to be aware of. So these are just a couple things I wanted to show you. There's obviously much more we can talk about, and we'll be doing that as the weeks go by. I hope you had a good New Year's weekend and are ready for the year to come. Oh, and if you're not on that email list, click the link, get on the email list. And if you want to get a notification from YouTube when the next video is up, click the subscribe button and then click the bell, and YouTube will send you an update. Have a good day. We'll talk with you later.